So in the case that you've got inflation because of excess aggregate demand, one of your options to reduce demand is to increase taxes. But I also add that I've been watching inflations for a long time now, 73 years ago. And I've yet to, it's possible, but I've yet to see one of them caused by aggregate demand. I just haven't seen it. I'm not saying it's not possible, maybe I missed the point out. I just haven't seen it. So that's the rarest kind of inflation that I've seen personally. And haven't seen it. So in the case that you've got inflation because of excess aggregate demand, one of your options to reduce demand is to increase taxes. But I also add that I've been watching inflations for a long time now, 73 years ago. And I've yet to, it's possible, but I've yet to see one of them.
Indeed, Popper says that, and now Warren repeats it. But then you give some nuances, but there are four nuances. Anyway, let's begin with me.
Yep.
I have another one for you. Modern monetary theory. This is from a Twitter user called Demetri. Modern monetary theorists will tell you that solving inflation is easy. All we need to do is raise taxes. Imagine trying to pass tax increases in this political environment. Crazy. The fact that smart people pretend this makes any sense remains an unsolved mystery. This is MMT or a myth?
It's a myth. It's a straw man argument. It's always Paul Krugman's argument about a straw man argument. They set something up and say it's MMT and then they prove something. So it's a myth. I mean, MMT doesn't. No MMT proponent I've ever known says that.
I haven't heard, we haven't discussed it in your example, right? You have never said raising taxes reduces inflation.
No, I say raising taxes reduces aggregate demand. So in the case that you've got inflation because of excess aggregate demand, one of your options to reduce demand is to increase taxes. But I also add that I've been watching inflations for a long time now, 73 years ago. And I've yet to, it's possible, but I've yet to see one of them caused by aggregate demand. I just haven't seen it. I'm not saying it's not possible, and maybe I missed the point out. I just haven't seen it. So that's the rarest kind of inflation that I've seen personally.
And then this brings me maybe then to sort of a very topical issue, inflation today, which is sky high, at least in where I am, Europe, and where you are, the United States. What type of inflation is this? This is not an aggregate demand inflation, is it?
Well, look, the word inflation has become a generalized term that doesn't tell you much, except it becomes synonymous for prices are high. Prices went up and they're high. It's not that they're going up next year, so right now I've got to pay this much for gasoline, I've got to pay this much for energy to heat my house, I've got to pay this much at the grocery store. So prices are high, and the real question people are asking is, why do prices go up? My incomes haven't gone up, what's going on here? Now, your first clue is that when prices go up without incomes going up proportionately, at least when I grew up, went to school, that wasn't inflation, that was a shift in relative value, a shift in terms of trading. Okay, these were, we had relative value stories versus inflation stories. When go up without, prices are high, and the real question people are asking is, why do prices go up? Incomes haven't gone up, what's going on here? Now, your first clue is that when prices go up without incomes going up proportionately, at least when I grew up, went to school, that wasn't inflation, that was a shift in relative value, a shift in terms of trading. Okay, these were, we had relative value stories versus inflation stories. Inflation is where everything goes up. The United States reprices from dollars to pennies, everything goes up 100 times. It used to cost $1, now it costs 100 pennies. We just had 100 times inflation. Okay, but your wages went up also. So we have a situation here where prices have gone up, particularly energy prices. And they went up for a couple of reasons. First of all, going back a few years, the first big impetus were the tariffs. The president decided that we needed to punish Canada because they weren't charging us enough for lumber. So we put a 17% tariff on lumber. So lumber prices go up. Oh, we've got inflation in lumber. What are we going to do about that? It's like, okay. Then we just, this is like a politically initiated policy because Canada wasn't charging us enough for lumber. Don't ever send these guys to a shopping floor. And then President Biden comes in and he decides they're still not charging us enough. So he raises it to 34%. He doubles the tariff. So now we've got lumber prices have gone up some more. And they're not going to come down because we've got these 34% tariffs. And it's like, okay, well, we have to raise rates, we have to do this, it's the Fed's job, oh, the money supply's up. This was just tariffs, okay, this is pretty simple. We just legislated higher prices. Gasoline taxes, we legislated higher prices. And then, so we had tariffs on 300 different items. The presidents love these things because they're bringing in dollars. Like the U.S. needs these dollars. And so it's a profit center for the U.S. to raise prices on the American consumer and bring in money. It's like, all right, that's what it is. It's a tax. But taxes count as, quote, inflation for higher prices. So we had that problem. Then we had the energy issue, which was, and I think the Fed gave that, and then we had the supply chain things from COVID, right?
But this
Plus
is
the tariffs.
yeah, okay.
And I think the Fed gave out like 0.5% a year of CPI increase. But the big one came through oil prices, right? So oil prices had broken during COVID, went down to $40 a barrel, negative on the gold trade. And then they went up to 120, tripling in the price of our basic energy. Natural gas went from $2 something to $9, right? And everything just shot up. In Europe, it's even worse.
Yeah, 600% at some point. That's a pretty insane increases in what I use here for houses. It has a massive impact for heating houses.
That used to be called a shift in relative value. Now you have to work more to earn the same temperature in your house.
But wouldn't it be called a shift in relative value if other prices went down to compensate for this? And I think this is also something some economists will say. Like, but if it was only cost push or from the cost side, then if we had stable amount of money following monetarism, then prices would go down elsewhere. That's a shift of value to many people, I would say.
Yeah, and that didn't happen. Okay, you could have had wages go down, I suppose, but to get our cost of production down, it would have been even worse. So that doesn't happen. Our institutional structure is not such that wages are going to go down. So it doesn't work in that direction. So other things go up. So you can call it inflation, call it whatever you want, but it's not like a monetary thing. So the answer to it is not to let's cut everybody's wages in half so the prices will come down in half. What's the point? Right? Yeah. So to get back to the
to where inflation is
thing about the energy prices. The other thing about the energy prices is they feed into everything. It's fertilizer to grow food, it's tractors, energy, it's transportation.
If energy prices now, gas prices going up here, or natural gas, I should say, to avoid confusion with the English language, natural gas prices going up in Europe means that a lot of cafes or bars will raise the prices for coffee because they cannot pay their bill anymore. Yeah.
Right. And the price goes up, if people don't shop there because they can't afford it, they go out of business. It's not like a market works. And the price of oil is legislated by Saudi Arabia. Saudi Arabia processing those fees. They set the price. There's no others, just like what the government, in terms of exchange, the government sets for its currency, set the information there. At the margin, the Saudis have a monopoly of oil. At the end of the day, we have to buy their 7.5 million barrels a day, or shuffle it for 600, 400. And so they're a price setter, whether anybody recognizes. They thinly disguise it by setting spreads instead of absolute prices, but it comes out to the same thing. And again, I'm not going to be partial criticizing one person. They're all complicit. But President Trump was on record with the Republicans of having the price of oil growth, demanding that the Saudis cut production to get the price up because our oil industry was losing money. And Congress had put a resolution through the Republicans to stop sending weapons to Saudi Arabia, cut off relations if they didn't cut production to get the price of oil up so that our oil industry survived. First of all, we didn't need them to do that. We could have done it without that happening. Instead of them raising prices, cutting production, and us paying more, we could have just given the oil companies money. It would have been a lot cheaper. I don't want to get into that because let's just talk about what actually happened.
Yeah.
And the Saudis were infuriated that our government would start making demands on them to do this. And they got together with the Russians and became OPEC Plus, and each cut by 5 million barrels a day or something like that. Got price up, and it's been going up ever since. Now they're buddies, and we're up against them.
So, Warren, so
yeah,
inflation now is the consequence of the government. The government did it, but Russian government, Saudi government, and the U.S. government started with tariffs. Can I summarize your argument like that, or is that?
Yeah. And there was some, you know, there were COVID issues for sure, but those were all transitory. They reversed. All the shipping's come back to what it was. These other things were the problematic ones. If we had gotten 3 or 4% because of the COVID thing, nobody would care. If we're up at 8 or 9, and it's scaring people because their theory says that if it gets too high, it runs away. It's not going to just, you know, it's not. It doesn't like mean revert or anything. That's what their theories say. It just runs away because they've got all these misconceptions of how it propagates, right? And we turn it to Venezuela, we turn it to Argentina, we don't get it now. And that's has nothing to do with what happened. Or we turn Weimar, even worse. It's got nothing to do with what happened. Okay, so we've got that fear, that mythology in our heads. Now you're talking myth.
Yeah. But so I can relate this back, maybe even to the transitory versus permanent inflation discussion. I don't know, were you a year ago or something in the camp, oh, this is going to be actually permanent because governments like Saudi Arabia and Russia are going to push this, or? Okay,
I've been in a camp, and I was there in like 2010, because back in 2008, the cycle didn't break until oil got to like 150. Saudis just started raising the prices until it broke the economy. Now, there were vulnerabilities, I'm not arguing that, but that was the catalyst to took it down. And, you know, I was thinking, here they are doing it again. Got up to about 120, and that if it keeps going, then the inflation keeps going. If it stops, goes down, stabilizes, then the inflation's over. It's entirely a function of energy prices. Okay, it was a little bit of a lag. So apparently Biden made some kind of a deal with President Biden with the Saudis back in July. He's going to use strategic reserve, but the only way the price came down is they agreed to discount their official selling prices under the table to drive prices down into the election. Okay, and then something happened a couple of weeks ago where they had a huge falling out and policy stopped. But anyway, once oil stopped going up and started coming down, you could see the CPI numbers in the US just went sideways. We were heading back towards zero inflation. 0.3 or something. We're back to pre-COVID numbers. And if oil stays here, then I think we're going sideways from the back. And it's been transitory only in the sense that oil went up, pushed everything up, comes down a little bit, levels off, everything comes down a little bit, levels off. When you look at lumber prices, they got up to 1,600, and now they're back to 500. Well, they were 300 or 400 before. They're up a little, but they're not, you know, that's tariffs and everything else. But that big burst is over. All those commodity bursts have been reversed for the most part. And we're back to pre-COVID levels of price stability, except unless oil and gas are going up. And I think they will. I don't know that they will. If they don't, then I won't expect the inflation to come better.
Right. So, but okay.
Except the higher rates are driving inflation. It won't come back to where it was until after we lower the rates. We'll stay. These rates will support inflation at higher levels than we would have had otherwise.
So okay, I like this because now at least, because governments like Saudi Arabia and Russia are going to push this, or? Okay,
I've been in a camp, and I was there in my 2010 because back in 2008, the cycle didn't break until oil got to like 150. The Saudis just started raising the prices until it broke the economy. Now, there were vulnerabilities, I'm not arguing that, but that was the catalyst to took it down. And, you know, I was thinking, here they are doing it again. Got up to about 120, and that if it keeps going, then the inflation keeps going. If it stops, goes down, stabilizes, then the inflation's over. It's entirely a function of energy prices. Okay, it was a little bit of a lag. So apparently Biden made some kind of a deal with President Biden with the Saudis back in July. He's going to use strategic reserve, but the only way the price came down is they agreed to discount their official selling prices under the table to drive prices down into the election. Okay, and then something happened a couple of weeks ago where they had a huge falling out and policy stopped. But anyway, once oil stopped going up and started coming down, you could see the CPI numbers in the US just went sideways. We were heading back towards zero inflation. 0.3 or something. We're back to pre-COVID numbers. And if oil stays here, then I think we're going sideways from the back. And it's been transitory only in the sense that oil went up, pushed everything up, comes down a little bit, levels off, everything comes down a little bit, levels up. If you look at lumber prices, they got up to 1,600, and now they're back to 500. Well, they were at 300 or 400 before. They're up a little, but they're not, that's tariffs and everything else. But that big burst is over. All those commodity bursts have been reversed for the most part. And we're back to pre-COVID levels of price stability, except unless oil and gas start going. And I think they will. I don't know that they will. If they don't, then I won't expect the inflation to come back.
Right. So, but okay.
Except the higher rates are driving inflation. It won't come back where it was until after we lower the rates. It'll stay. These rates will support inflation at higher levels than we would have had otherwise.
So okay, I like this because now at least we're getting back to sort of.
But is that MMT? MMT isn't that oil prices cost. That's everything.
Yeah,
I think that's.
I think almost everybody agrees that oil prices have played a big role in inflation in most countries, like even monopolists, I would guess. Yeah, but okay, that's all right. Because then I think we again get back to even where I'm not fully convinced yet, but I do think it's a very valid argument in the sense that we get back to this interest rate debate. Like, does it cause inflation or does it reduce inflation? Well, that really depends on, is the borrowing effect, less borrowing, stronger than sort of more money through the government paying more interest rates effect?
So will the borrowing effect be overwhelmed by $1 trillion a year of interest payments deficit spent by the government? It's a big number. Just, I can't say for sure it will, but I just say look at the data. Everything's going up again.
Yeah.
We bottomed out second quarter and it's going up. That was before. For the rate hikes. Since the rate hikes, everything's going up.
But this gives me an opportunity to move to the last subject that I want to discuss with you here, because our economies are also partially quite complex in the sense that we live in an international world. And I know you have made reference to sort of your university example, also living in an open economy, so I'm sure we'll get to that. Yeah. But we have, and MMT discussions tend to be held in a very US-centered sort of way, which does issue the reserve currency at the moment globally.
Yeah, but I think that's just empty rhetoric also.
Okay, so that's interesting. So I didn't necessarily say too much about it yet, but perhaps people would say MMT only works in the US because they have the reserve currency. Is that what your sort of is empty rhetoric, or is it broader?
Yeah, that's not.
Okay.
That's not applicable. That's
so
statement.
So that's not the argument I wanted to make, but the one thing that I did notice is that you said in one of your papers, or made reference to, like, okay, maybe sort of more mainstream economics can work in a gold standard world, right? But if we have floating currencies, MMT always applies.
Well, it depends how you define it can work. You can't sustain full employment. And if you want to optimize your prosperity, your real wealth, you have to have full employment. Because your real wealth is everything you produce domestically, plus your imports minus your exports. It's old as economics goes. It's hundreds of years old.
Okay.
There's no refuting that. And so, if you're less than full employment, you're losing your real wealth. So why would you want to pursue that?
So if I can translate that, and this is true, right? I think nobody can deny that no current economic systems have sustained full employment. That's never been the case. So unemployment is the norm, sadly.
And you could say the losses from unemployment in 1 year, probably just the United States, just Europe, are larger than the real losses from all the wars in the history of the world put together.
That's interesting, yeah.
Given today's price, probably just the United States.
So if I can translate that, and this is true, right? I think nobody can deny that no current economic systems have sustained full employment. That's never been the case. So unemployment is the norm, sadly.
And you could say the losses from unemployment in 1 year, probably just the United States, just Europe, are larger than the real
employment is the norm, sadly. This is true, right? I think nobody can deny that no current economic systems have sustained full employment. That's never been the case. So unemployment is the norm, sadly.
And you could say the losses from unemployment in 1 year, probably just the United States, just Europe, are larger than the real
Jai. Welcome to the Macro Show. We have Taylor Burnett in the studio. Mysterious Drago beamed in from, I think, Florida, but could be parts unknown. So we're going to go through the top three things, macro, companies, and financials. Open up for Q&A.
There we go. Let's have it. Let's kick it off with the top three things. Bringing the first one, we've got Quad 3. These are a little lengthy. Christian Drake was on the typewriter this morning typing these all up, so make sure to give it a read. I'm just going to paraphrase them real quickly. The first point, Quad 3, stagflation trends on global PMI. We just had German industrial numbers come in, and they're essentially bringing Eurozone composites within the 3-year contractionary band. On the second bullet point we have here, again, a nice lengthy read. Please go back through it. It's awesome stuff. But the consumer indeed remains strong, LOL. And pretty much the big takeaway here is, right, it's something we've been talking about. Delinquencies are rising among credit card holders, and the speed at which they're increasing is being faster than expected. And lastly, on the housing front, it's kind of been this ongoing theme that we've been seeing. New week, same dynamic. And again, 30-year rates at a fresh multi-decade high continue to drive all the housing volume to new lows. So that's kind of the big main takeaways. And on that, I will then toss it over to Drago to go through.
Great. Thank you, Taylor. Thanks, Daryl. So I just thought, do a quick little kind of crash course or review of our short call on American Express, ticker AXP, over on the financial side. We recently sort of presented our refresh thinking on that, so that'd be a good opportunity to change gears up a little bit and see what's going on there and review our thinking. So the first slide here, just a quick top line breakdown. You can see 80% of revenue is non-interest revenue, so this is primarily a spend business, or presents as a spend business. You can see on the bottom right-hand side, this is their non-interest revenue broken out by their business segment, U.S. consumer and U.S. commercial. U.S. commercial, the majority of which is comprised of U.S. SME, represents about close to 2/3 of their non-interest revenue. So from a macro standpoint, we're going to really be focusing on the undercurrent there. Next slide, just looking within non-interest income and the sources of revenue within that line item. Discount revenue was obviously the main contributor there, and that is a function of American Express's proprietary billed business, or the payment volume that runs through their issued cards. And as a reminder, American Express, unlike Visa or MasterCard, is a closed-loop payment network. So it is both the issuing bank and the acquiring bank and the payment network, and it therefore captures the full economics across the payment value chain, and that is represented by the merchant discount rate. Next slide, just kind of a look at Amex's cards in force. So, there was this sort of loss in the wilderness period from 2016 after the loss of Costco, going into sort of the pandemic, and then as we kind of got on the other side of the pandemic, and we had this unleashing of pent-up travel demand, and American Express's product portfolio being smartly sort of oriented towards travel and lifestyle really was taken up greatly by the consumer, particularly the high-end consumer, and you saw cards issued really explode. Next slide, this is just sort of looking at network volumes by segment, and we have it. We can see here between U.S. consumer and U.S. SME, we get about 52% of spending, and that's going to be important for later. Next slide. This is what's going on within each segment. You can see just a broad kind of downtrend or normalization in billings growth, but particularly within U.S. SME and U.S. large and global corporate see that was particularly driven by a pretty rapid deceleration in T&E spending, and of course, T&E spending within U.S. commercial services has never really quite recovered to pre-pandemic levels, and that's obviously because business travel continues to be impaired. Next slide, the sort of moderation in T&E spending is holds across the different segments. Here we're looking at it at a company level. Obviously, there's a mechanical slowing element here, which is due to the nature of HVAC. That's really been the source of billings growth, and that is moderating towards the neighborhood of pre-pandemic levels. And if we combine that with goods and services spending on the next slide and look at their worldwide billings growth, you can see we've already slowed back down to this pre-pandemic level of growth. Next slide, we just kind of ran some analysis on American Express's U.S. or domestic billed business versus some of the product categories with a nominal PCE, and it's interesting. It appears domestic billed business is much more indexed towards services. They don't really break out. Company doesn't break out the distribution between services and goods spending. But we can see within services that the discretionary skew of American Express's billings, and that's sort of part of the short thesis here. They have exposure to discretionary spend. And on the next slide, American Express does not have debit products, right? So it sort of amplifies its pro-cyclicality because it is reliant totally on credit spending, and we've shown in Quad 4 growth flowing environment, credit underperforms debit quite significantly. Next slide, on slide 11, next slide here, we have three charts showing payment volume growth between Visa, MasterCard, and American Express versus the growth in nominal PCE. And this is meant to really showcase the secular growth premium across quads. And the secular growth premium, of course, refers to the ongoing digitization of cash, and that benefit that accrues to the payment card network. And you can see that in the case of American Express, particularly in Quad 4, that secular benefit is much smaller than MasterCard or Visa, and that's of course because of their total absence of a debit product, and we think that's going to be very relevant here shortly. Next slide. Another reason why the sort of secular benefit of cash digitization has been sort of weaker within American Express is due to just a loss of market share over time. So if we look at U.S. credit card payment volume between the four big payment networks, Visa, MasterCard, American Express, and Discover, you can see how American Express's share has shrunk over time. Next slide, just sort of reducing this. From a macro standpoint, we're really going to take a look at what's going on with the U.S. consumer and U.S. SME, because it's about 62% of network volumes. Next slide, kind of a dashboard reflecting the sort of small business condition set. And, to really summarize, you have this confluence of slowing sales, weakening outlook, and sort of elevated wage pressures, really keeping small business optimism and therefore, SME spending, or keeping small business optimism depressed, and therefore setting U.S. SME spending, on a course for weaker performance. So that's relevant as far as American Express's U.S. SME segment, which is 25% of the network volumes, and which we saw slowed, in quite a pronounced fashion last quarter, particularly within the T&E segment, which was obviously the more discretionary component of SME spending. So that's what you would moderate first if the conditions are deteriorating. Next slide, interesting to call out. Obviously, American Express is over-indexed to the high-end consumer, and we've really seen white-collar employment within, technology, financial services, professional business services, industries, and the contrast from the broader picture there is evident. Next slide, Bank of America Institute put out their consumer checkpoint report, and they flagged some interesting data there, showing that wage gains have actually been the slowest among the high end, and unemployment is seemingly more prevalent there as well. And of course, this has to do, I think, sort of largely with this sort of new cost of capital regime that we're in, and sort of the discipline that's being imposed by investors and the market on, previously profitless companies, and that, of course, is manifesting in reduced headcounts, particularly among these sort of, white-collar sectors. Next slide, sort of reiterating the point, you can skip over that. Next slide, just a look at real luxury goods consumption. Obviously, there's been this sort of post-pandemic shift away from goods services towards spending, which has driven part of this, but it's still relevant because it's quite a pronounced slowdown, and it speaks to, maybe some of the underlying consumption patterns within Amex's high-end consumer. Next slide, sort of courtesy of the hedge retail team, you can see a slowdown in Swiss watch exports, down from up 14% in June to down 1% in July. Most of that's international driven, but you do have, a pretty big slowdown from about 9% to 5% within the U.S., so that's relevant as well. Next slide. Obviously, there's been a lot of talk about the kind of cycle extending effects of, these sort of pandemic-induced excess savings. And the San Francisco Fed did a very interesting study that they published early last week, and sort of the conclusion is that there's about 190 billion of remaining excess savings, and that's expected to be depleted and brought down to sort of the level implied by the pre-pandemic trend by the end of this quarter. So it's, there's sort of potential here for the broader economy, but particularly, obviously the consumer to, lose the thrust or the stabilizing effect of that excess savings in their consumption. Next slide, just going to switch gears to this kind of student loan boomerang. Looking at this chart here with the Brookings Institute, you can see on the x-axis you see a family income decile, and on the y-axis you have sort of the percentage of household, percentage of total student loan payments, and you can see the sort of right side or positive skew there, and the point is that, the high end actually has, much larger student loan payments and disproportionate share of total student loan outstanding, and that's to be expected. Higher income households typically carry larger student loan balances because of a larger sort of prevalence of graduate degree holders, med school graduates, MBAs, lawyers, etc. So the payment pause benefits were really sort of had the greatest impact on the sort of high income households. Next slide. Obviously, Amex always touts sort of their credit outperformance, but you can see here that households with the highest student debt also have, while they have the highest incomes, they also have lower FICO scores. And on the next slide, we sort of recall the kind of FICO credit score migration or inflation that happened during the pandemic, and this chart sort of demonstrates that kind of upward trip of credit scores from 2019 to 2021 due to these pandemic dynamics, which obviously include the student loan payment moratoria. Excuse me. Next slide. Interesting. You can, as I mentioned before, 12% of student loan borrowers account for 47% of total student loan debt. So that 12% of borrowers are borrowers with outstanding balances greater than $75,000. So these are the doctors, the lawyers, the NVDAs, the dentists who will be moderating their spending once payments start back up in September. They account for 47% of the outstanding student loan balances. Next slide. We thought this was interesting. Income-based repayment plans are unlikely to bail out these sort of high-end borrowers because those same borrowers, have very high incomes. And next slide, we feature this in our macro work, just kind of quantifying the impact of the pause in student loan payments. So, our estimate is that about, you could say 2/3 of real PCE growth has been attributable to, the pause of student loan payments, which are set to expire here in September. And interestingly, on the next slide, this commentary from Amex's latest call, management is sort of already kind of, narrative, I guess preparing the runway. This kind of low growth commentary was totally absent just last quarter, on the call last quarter, the quarter before that. And, it was mentioned, of course, several occasions during the second quarter earnings call, and, we think that's, of course, noteworthy. Another sort of noteworthy mention, is sort of this kind of, on the next slide here, we have a decent amount of, relatively low interest bonds that are expected to mature between, the second half of this year and early 2024, and that carry sub 4%, or sub 3% in some cases, coupon rates. And of course, that's going to be represents refinancing risk with cost of capital, but really increase there and pressure net interest income through a higher cost of funds, and net interest income still accounts for 30% of revenue. So yeah, just to conclude, we're thinking about Amex on the short side through the lens of a slowdown in high-end consumer spending, with that slowdown expected to be exacerbated by this student loan dynamic, and sort of Amex's kind of pro-cyclicality being amplified by their heightened exposure to discretionary spending and credit card spending. And of course, this debt refinancing issue is an additional near-term concern, and we don't find the stock to be particularly cheap with the price earnings next 12-month ratio just at about 13.6 times, which is right at the average level over the past decade. So a little crash course on our thinking on American Express, which we have on the short side and over on the financial team.
Great, thanks a lot, Drago. We'll get to some questions here. Before we do that, though, I actually thought your point on small businesses was interesting. Because yesterday we had the NFIB Small Business Banking Survey. The commentary with that was interesting in that they said basically just over 50% of small businesses think we're already in a recession. And I think 54% or so think the economy is going to get worse in the next 6 months. So it sort of speaks to, we obviously all follow the stock market. We know that certain names are doing really well, but when you kind of go to the underlying engine of the economy, which is small businesses, they are quite pessimistic, actually. But with that, we'll get into first questions here.
Well, Johnny, hold on. I got to present some title insurers, but we also
okay.
give Drago a chance. Yeah, we got a little bit more, and I'll go through quick. But Drago, also, if you want to touch on anything that Johnny was just bringing up.
No, I echo that, of course. Especially on the credit side, credit availability and sort of cost of credit. Small businesses don't benefit from having been able to lock in, also low rate financing in the debt capital markets. As some of these large and global corporates have. So they're feeling the bite on multiple fronts.
Okay. So title insurers.
We're going, so we're doing the quick opposite side of the coin. We went short. Now here's the longs we have. We just presented this as well on the financials team. It's for First American, ticker FAF, and Fidelity National, FNF. A couple of these I'm just going to kind of leave as for you to read. And again, the real big takeaways for us is, and we also touched on it in the top three today, is one, the housing's medium to long term macro setup. right now it's been this ongoing thing, and once that starts to turn around, it'll be attractive. Elevated rates has caused trough title activity, and because of this refi environment, the companies have had to employ an aggressive expense management program to essentially continue to operate well. And so coming out of that, they're running leaner, they're running meaner, with new initiatives, and that should serve as a tailwind for them as soon as we start to see rates move lower.
And is the big driver here housing activity?
Housing activity.
Self, buying.
Exactly, and it's pretty much
changing of titles.
changing of titles. Yes. And a couple of slides as we get into it, we'll be able to show how the home builders versus title insurers and everybody else are kind of playing out.
Okay.
So real quick, from just a macro level, when we presented the deck, you can see in this first slide on 43, I think, guys, this one, there we go. Maybe it's a little hard to see, but look, you can kind of see the year-over-year rate of change in just loans and leases. And the big thing we've been flagging on the financial side is that tightening underwriting. Well, fast forward, right, so that ends 6/16. I updated it this morning with the most recent deck. So on the next slide, you can see, well, that's continuing to happen, right? So in 5/28, that year-over-year number was 7.7. As of 8/11, that year-over-year number is 4.8. So again, this ongoing, continuing deceleration, and essentially emphasizing the tightening. This next slide, I really am just going to leave it for you guys. This is from the housing team, and again, it's just a really good fundamental summary of what's going on. Also, what Jonesy had just mentioned with regards to just where inventory and purchases and things like that have been. Next slide, though, which is going actually off of what you were just flagging. Right here, you can see this really interesting dynamic where home builders, anybody who's bringing essentially on new supply has been a beneficiary. Anybody who is got exposure or tends to be, I guess, has more of an impact from existing home sales, they've underperformed, right? And you can kind of see title insurers land right there in the middle. And again, that is kind of our call, right? Once this new supply starts changing into an existing supply story, title insurers should benefit. As we go to the next slide, real quickly, we're trying to flag existing home sales continually. And these are a little outdated, but from our housing tech presentation. But the big point here is existing home sales continue to go lower. That provides an easier comp setup, and that'll serve as a tailwind again for the title insurers. On the next side, this is just a longer term backdrop of looking at the inventory. Again, we are at pretty historic lows. It's a couple weeks behind, just given from the housing team, but
Is that on days sales or is that arrived?
I think this is month supply.
So that's, I think, the other key point. Month supply is obviously derived from the demand, but if you actually look at raw inventory in the US, it's literally the lowest it's ever been.
Yeah.
Which is crazy. And part of it is it's too expensive for people to move, but even setting that aside, the inventory just doesn't have to be extremely low level. So that's why home builders are doing well, and why when rates do come down, they come back. There's probably going to be a lot of activity.
Right, to your point, people, the high rates and the higher prices of the home is just the affordability issue, is just completely getting rid of demand for the existing supply, so your point. And I included one or two slides that kind of show that rate dynamic versus the existing supply. So the next two slides are really, again, just refi applications. You can see that these are just they're at the absolute lows. That is also kind of going off of what me and Jonesy were just saying. I'll skip ahead to rates versus home sales, so slide 51 in the deck. And I think this kind of captures exactly what you were just saying, right? You see there is no better other chart, I think, that really captures this. So when you're seeing these rates tick up so higher, you can see that the existing home sales fall dramatically. Now on the next slide, we'll see the flip of it, right? Now when rates start to ease, then we're going to see, we're going to see existing family home sales go up, and that's really the call. Like, we don't want to overcomplicate it, right? It really is just that straightforward. And again, it's now just turning into a timing thing. On to the next slide, we go to title insurance process. Again, I'll leave this for you. I'm sure most of you are pretty familiar with title insurance and how it works if you've ever bought a home. This is just a little bit of a granular rundown of kind of how it works. and I'll let you review that on your own. The other thing we wanted to flag is the business models of title insurance versus P&C. The real big thing to highlight is obviously the expense ratio versus loss ratio. Yes, they have a higher expense ratio, but if you look at their loss ratio, it's significantly lower. That is because the way underwriting for title insurance works is pretty much done all up front ahead of time. And I'm sure, again, as many as you probably know how when you go get a title insurance policy, how that happens. This again just kind of shows that it's a total different insurance model relative to what everybody else is used to, and for what you can get insurance on other products. Turning to just a quick high-level company comparison, the big thing we're trying to flag here is these are your two big players, right? They dominate over 50% of the market. They run similar sizes in assets, similar sizes in employees. They have a national footprint. First American is pretty much only all title, where Fidelity does have a little bit of a life annuity segment of business. They have spun that off under F&G, but they still have ownership for it, and so that is just another stream of revenue that they have. It kind of counters the cyclicality that we see in housing. On to the next. This is just a broader view. It just shows the big players. This is a really concentrated market. On the left, we kind of show F&F umbrella. That includes Chicago Title and Commonwealth, right? So if you looked at just Fidelity right there, you would see, oh, hey, it's 12%. But the other ones, other subsidiaries, you bundle that all up. The F&F umbrella serves, as we showed, roughly 30% of the market. First American, a little over 20% of the market. And so these two are your big players. The other thing we wanted to kind of show, in the 5 largest title premiums have absolutely collapsed, and we're showing this by the markets, and you can see where they were in
Gold.
2021, and then where they are today as of 1Q22. I mean, just absolutely collapsed, and that again serves as this bottoming serves as easier comp moving forward. Again, once we see rates turn over, the story for the title insurers.
XLV.
On the next two is again kind of a reiteration of what we've already talked about, the refi activity, and so I won't harp on it, and the rates, the purchase index, again, it's this, you can see this inverse correlation, rates higher, refi's down, purchase is down. When rates turn over, that'll be that. Turning to so 60 just is a table, but
Trim a little monster.
A time series, which we can just go to the second one. Order volume has essentially troughed for both open and closed orders. Again, this serves as a positive tailwind for the companies coming out of this. And this is across First American, Fidelity, Stewart, and Doma. And Doma is essentially an what is it? I don't want to say iBuyer. I'm blanking on the term, but they are a digital platform, right? And so they are very, 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 very small player in terms of the volume. But again, just interesting just to see them. They're actually performing worse than the other guys, so just an interesting caveat there. And the last 2 to 3, I really just kind of wanted to highlight on, again, these are some correlation analyses. We just wanted to highlight when the rate moves down lower, you will see a lot more refi activity and mortgages hitting the market again. And
oh yeah, we're buying Halliburton and Schlumberger.
And First American are heavily correlated. And
buying Big Red and Big Blue.
Refi is going to be off of the existing home sales, or I mean the MBA purchase. For F&F, you can see those correlations over there as well. So just wanted to flag that. When we adjust First American on the next slide, we looked at revenue versus just average annual revenue versus mortgage rates. Really not a strong correlation there. However, when we adjust revenue for home price inflation and then compare it against mortgage rates, that correlation becomes way stronger. And so really the last thing is these 2 quick little slides. You can look at them on yourself. The big point is we can see when rates do collapse, how their share prices perform. That's really the big tailwind coming from here. So on that, I will wrap that up and send it over to you.
So we have a long and a couple, short and a couple longs.
Yep.
We're gonna get some questions quick. Going over
Oh yeah, P-Fix.
Rapid fire. Number 1 question here from Tom. What would be the main market driver for the next month? Yield, dollar, or gold, and why? Obviously, what happens in the future is always a bit uncertain. I would say right now that the dollar is a big driver of everything. Obviously, related to that is relative interest rates.
XLE is on sale.
Versus other parts of the world, but what's happened over the past couple of weeks, the dollar has really
USO.
correlated positively. So you can see that there. But you look in sort of the red column, and the dollar is really driving.
XOP. It's all on sale. The whole energy complex is on sale.
Doesn't really do much with rates from here, right? So the rates just stay high for an extended period, and there's less kind of volatility around the dollar. I mean, we'll have to see, but right here, probably in the intermediate future, I think the dollar is going to be the big driver.
No, I completely agree. I don't know if Drago, if you have a different view, but
No, I echo that.
Okay. Next question is Les in Virginia. Taylor, I appreciate your comments on the oil patch as Tex, aka a Texan. Can you address the quad back test for oil and gas for situational awareness as we oscillate between quad 3 and quad 4? And you and I have talked about this a lot, but big driver in the U.S. supply side.
Ooh, small cap energy.
Drilling activity again hit a new year-to-date low, down about 20% from its peak, down well below pre-COVID levels. So we have this constraint on the supply both domestically and internationally, which is definitely big. Your thoughts on oil?
Okay.
yeah, no. I think
Big bunch of
it's a great question.
big bunch of buys here.
I went to go just look at just what the USO does by quad. Obviously, 2 and 3, or 1 and 2 are going to be its best performing, and 4 is the worst. But even the 3, it is a positive performer. The one thing I will also want to flag, one, echoing what Jonesy flagged, but 2, the interesting thing about the quad back test now and everything that's happened isn't going to necessarily, I think, capture also what's happening back in like 2015 and things like that, where OPEC will now moving forward, as we're seeing their aggressive rate cutting, I think that's going to, it's a different setup also as well from the standpoint of they're never going to allow, I say never with air quotes, allow oil to get back to that $40 level, right? They will be way more aggressive. There is a dynamic this is not the medium to discuss now because it would be too long, but where U.S. activity was a large percentage of all production, and as a result, OPEC had to kind of pump the brakes. After we seen that in 2015, when the U.S. was oversupplied the market, we essentially saw what that did to crude prices. OPEC's now never going to let that kind of quote unquote happen again.
Yep.
So you have these dynamics that I don't even think that the quads, but you can't model OPEC activity just because it fluctuates so much. But at the same time, I think the quad setup still, I think, favors crude, along with all the other geopolitical factors as well. Support it.
Okay. We'll do a couple more questions and wrap it up. This is from ABC. This is probably a Drago question. Hard spend seems to have given back more than the acceleration we saw in July and early August. Is there anything
Occidental
that
Petroleum.
expecting
Boom.
weeks/weaker
Boom. Got him.
August?
Burn. Burn.
Any thoughts on that?
Yeah. So definitely having red hot retail sales growth there in July. The student loan dynamic is really expected to sort of take effect in September when payments resume. So we'd be looking for a more pronounced slowdown in spending. Then as we know, we think that effect is going to be actually more pronounced within the high end than sort of the middle and lower segment of consumer, and that's really why we think it's kind of a near-term downside catalyst for American Express.
Yep. So last question here. And we don't really do price targets, but I guess we'll start with American Express. American Express, what kind of downside are you looking at on a percentage basis? Or
Yeah, so I think, we kind of pinned it around like 20%, you know, 15 to 20%. It's already been kind of this sort of underperformer over the past year, and there's kind of a secular and kind of cyclical sort of argument to our short thesis. I just sort of kind of previewed the cyclical elements of it here.
So it's sort of a place within large or mega cap financials where you can draw out some alpha. It's going to be
Absolutely, especially relative, yeah.
And then title insurers, I would think there's a lot of upside, especially over a multi-year period when rates will eventually come down and activity should increase rapidly. So what do we think the potential upside is over time?
Yeah, for them, that's exactly the key. It's a multi-year play, right? It's not the short-term thing, and so if you look at it over that duration, and we looked at past analogs, both of these names can easily melt up over 50%, right?
Yeah.
But again, with the caveat being it is over a multi-year time frame, these stocks have recently pulled back as well, and I think a lot of that data, the hawkish commentary, all supports this. Okay, well, when is it going to happen?
Yeah.
But I think you'll see is I think they've been a little conservative with what they're saying rates need to be at for things to really elevate. I think things can turn around somewhat quicker than maybe we think, but again, it is a timing play. But yes, yeah.
And they'll move ahead of activity.
Exactly. Yeah.
All right, we're going to wrap it up there. Thanks everybody for tuning in. Back at it tomorrow at 9 a.m. Take care.
The losses from all the wars in the history of the world put together.
That's interesting, yeah.
Given today's productivity.
Yeah, and given that this happens all the time, and wars and everywhere to the whole population,
Yeah.
and wars only happen in specified places, some places. And
Yeah.
okay. I mean, this is definitely a problem that I also have struggled with, especially when I briefly lived in South Africa, where unemployment rate is sky high, is 25 higher percent, which is
Staggering losses.
yeah, because people are just sitting around, right? They're doing nothing. That's a real shame. That's indeed, and this is, I think, what you refer to as the loss of real wealth, because they don't do anything. They're idle.
It's a loss of real wealth, and a loss of humanity and everything else. I mean, it's a lose-lose-lose situation.
But one thing that I could imagine, if I were to start a currency now, in a new country where I'm dependent on perhaps imports, I might need to charge interest rates because I want to anchor my currency to another currency.
Yeah, see now.
But that's maybe the gold standard type of world again. Where
When I decompose all that, it doesn't make any sense to me. It was go through bit by bit, but that's just.
So I could imagine, like, if I want to start a small island nation next to Europe, for example, I want to start out by anchoring my currency to the euro because that.
Wow. Why didn't the UMKC anchor their currency to the dollar?
Sure. I mean, let's make it easier then, right?
In fact, they talked about it, but we said, like, why would you do that? Nobody could come up with a reason to do it.
Because it makes trade easier to Europe or to US in this case.
I don't think so. I mean, I've said to somebody, like, I used to do this talk something. What if you go to full employment, Italy can't buy oil?
Mm-hmm.
It's like, show me one country in the world ever they can't buy oil. A friend of mine, Marshall Rick, was sub-Saharan Africa or something.
Sri Lanka cannot buy oil at the moment, right?
Well, if you Google, they had a different kind of problem because they had all the importing organized by the state. But I'll bet right now, if you Google Sri Lanka petrol station, gasoline station, you'll see a station with people filling up their cars with a price in local currency.
Yeah, but they cannot buy enough oil. I think that's pretty
You got to fill your car up and they won't pump shuts off. I don't think so.
I mean, why are they queuing then?
Price might be too high. Are they still queuing? I don't know.
I'm not sure if they still are, but they were for a long time, for sure.
I assume if they were still queuing, I would have seen them. You can look it up, but fuel, it may have specific. They have a fixed exchange rate just like you under plenty of countries operating without fixed exchange rates, weak currencies, impoverished countries. There's stations where you can buy it. Now, most people can't afford it, but the oil companies will sell it based on going exchange rates, whatever they are. Okay, and it turned out I was with a economist named Marcasio or something in Rome, telling me, well, in 1973 you couldn't buy oil during the crisis. And then somebody else told me, no. What happened was in 1973 the government did not want you to buy oil because they didn't want you selling it. And so they were trying to discourage people from doing it. It wasn't that oil companies wouldn't sell it, so the government didn't want you to. It was the opposite. They were tripping over themselves trying to find ways to deliver it, and the government said no. So, and if you look at any country in the world, and you look at the global south, you say, what's your macro problem? And they say, oh, too many imports, or imports exceed our.
Yeah.
Okay, that's the problem is too many imports. Have you ever seen one country where the problem was you can't import? I've just never seen it. I mean, aren't they?
Well, I mean, Afghanistan at the moment cannot buy its crucial imports. Lebanon cannot buy enough food imports, right?
So, what does that mean? People can't afford it at the going prices of local currency?
Yeah, at the going exchange rate, and that's why the exchange rate is collapsing.
Right. Okay, and so if you look at the total, but then you say that's what exchange rate, that's exchange rate is what it is. And it's collapsing for other reasons. And I don't know what their interest rate is, but I was just in Argentina, and the problem there was, they were paying 50% interest on the peso debt, and because their inflation rate was 40, and they had to keep a real rate. But the interest goes to people who already have money and they don't want it in their business, so they just sell it for foreign exchange. So the exchange rate goes down, like we're talking about, which causes imported prices to go up. So inflation rate goes to 50, so the government pays 60. So now that people are getting 60% in pesos, it's like 10% of GDP in peso interest. Selling it causes the exchange rate to go down, and they're in this spiral. It just went 80% inflation and 90% interest rate. It's like no end to this, because the interest payments are being fed into the foreign exchange markets and pushing down the exchange rate, pushing up imported prices, which pushes up the inflation rate, which pushes up interest rates. It's just the horrible cycle they're in, and they keep doing it. Now, maybe the same thing's happening in Lebanon. I don't know. I don't follow every country in the world, but if you look it up, more often than not, there's something like that going on. It's just insidious, and it's at the expense of all these people who can't get enough to eat. It's got nothing to do with operating, with a fixed versus floating exchange rate.
Well, I mean, so one thing I wonder about the whole fixed versus floating exchange rate debate that there is in broader economic circles, because also I think in more mainstream circles there was the idea floating exchange rates solves most of the macroeconomic problems. I think even someone like Milton Friedman was in favor of it.
Yeah.
But there I wonder, how floating are exchange rates actually, in the sense that if there are small movements, it's totally fine, and I think it works really well. Also, euro is considered to be freely floating. But I think what, for example, you can see in Turkey is that if the moves are too fast, then it does become an issue because imports do get way too expensive. And so, in effect, how floating is it really? Does that make sense?
What's interesting, and they are. I mean, you look at Japan, it's down 30-40%, right, recently.
Yeah.
Europe dropped by the same amount. The dollar's dropped by that amount before. The Australian dollar went from 105 to 60 or something. All these currencies move a lot. It's not, they don't all abandon them for the gold standard. They all move. and it doesn't like have all these horrible effects. In fact, you can't get politicians to agree on whether they want their currency to go up or down. The Chinese currency goes down, everybody starts yelling at them for unfair trade. It's like, right? You went in with too strong into this agreement, too strong an exchange rate. Now they trade stuff. So it's even ambiguous within the political debate whether they want the currency to go up or down. They don't even have that sorted out.
Yeah, but it might depend on the situation, right?
Okay.
In some cases, you want it to go up. Like now, for example, now there's high inflation everywhere, so you don't want your currency to go down too much. Like if I'm running Europe, I'm not.
What's the inflation? What's the inflation rate in Japan?
Well, I think it has been going up since the yen has gone down a lot. Well,
Yeah,
they want it,
2.6.
right? They don't mind.
Well, that's what I'm saying. You know, that's what I'm saying. It's like, I mean, I have opinions on where it should be, but I'm just talking about the political class doesn't have a clue. They talk out of both sides of their mouth from one day to the next.
Yeah, but you can.
They contradict themselves in the same sentence.
Yeah, but you can. Okay, fair enough. Like I'm not going to defend the political class, but
That'd be too easy for me.
but I will say, as a European, I liked the exchange rate going down a little, especially as someone who operates on YouTube and has a dollar income. Okay, I'm like an exporter of services in that way.
Yeah.
So I like that.
Yeah.
But now I don't like too much that the euro is not collapsing, but going down so quickly. Because it adds to a lot of inflation, since Europe imports a lot of stuff that I typically do like to buy from places like Asia, and you do see that, I think, in increased prices and all of that.
Yeah. So it's going down because, of course, the high prices you're paying for prices that are being dictated
By Russia.
And Saudi Arabia. And, those euros are being spent. People don't particularly want them. And they're it's raising the cost of all your production, so your exports are less competitive. And your trade balance just reversed, right, from plus 300.
Yes, in Europe, yes. It used to be current account surplus region, a long time. Now deficit, yes.
Right. So and Japan had the same kind of reversal. All the energy users had reversals. The U.S. has the lowest domestic prices of energy, so our exports are going up, which is helping the dollar. And a lot of what you're looking at is strong dollar versus weak euro too. So when there's things going on in the strong currencies that will help you. Now we can get a currency discussion for 10 hours or so. Probably not a good idea. But did you have any more MIT versus MMT?
I do, yes. Let's. But actually, I think that this would also be a good point to ask some more audience questions, right? I think I've seen a lot of them come by. So let me see. I did also get a question about Norway. So the question was from a channel called Political Economy, and I believe it was about Norway's foreign wealth fund. So very wealthy through gas exports, right? So the question there was, does that help the Norwegian government's budget? Does it help the Norwegian government to spend more?
What happened was your real terms of trade improved dramatically with the new oil. And so gives you the benefit of being able to, you're exporting oil, so you can import all kinds of other things with the proceeds. And so it's just a big increase in real wealth for Norway through its real terms of trade. Now, and the exports, of course, would cost. You could have kept the oil for yourselves, but you sold it and got dollars and put funds, and now you can use those to buy imports. And that's your deferred compensation, you might say, for the oil you sold in previous years. And I guess you're still selling oil today, right? I don't know, are you a net exporter still? I'm
Norway.
I mean, you're not Norwegian.
I'm not Norwegian.
But from the point of view of the question.
Yeah, definitely. I mean, Norway is a net gas exporter, so they are running the biggest current account surplus. They're maybe the only country in Europe still running a current account surplus.
So that allows more imports, and so your terms of trade just improved by the price differentials, gas prices coming up.
All right.
Huge.
Yeah. I have another question from Buck Franks, who asks, why wasn't inflation coming down on its own during the Volcker era, and they had to enact harsh hikes?
Okay, the inflation came down when the oil price broke. It went from like 40 to 10 or something over a couple of years, but 30-ish and 20, and it started coming down.
Was that after the rate hikes or before it?
That was after the rate hikes. but after the recession, it was caused not by the rate hikes, I was there, but I didn't see it coming, but by the fiscal tightening. And the fiscal balance tightened because of the inflation that the rate hikes helped perpetuate. So for example, we had inflation, 12%, and we're running a budget deficit of 6%. Well, in real terms, that means the public debt is dropping by 6%. So that's like running a budget surplus of 6%. And it just got too low to support the credit structure, which was growing because of the inflation. Prices were borrow more for working capital, and business, and just we call it general money supply. The whole thing collapsed because of overly tight fiscal policy, which looked loose on the surface with a 6% deficit, but beneath the surface it was a 6% surplus because of the 12% increase in prices. And it caused a horrible cave, and nobody quite understood what it was. They blamed the interest rates on it. The interest rates were actually contributing to the 6% deficit. They were contributing to prices going up, which then caused the real public debt to fall. So in that sense, indirectly, the interest rates caused the public debt to fall because of the inflation. And that's what caused that big crash. And that brought the demand for oil went way down.
I have another question from Buck Franks, who asks, why wasn't inflation coming down on its own during the Volcker era, and they had to enact harsh hikes?
Okay, the inflation came down when the oil price broke. It went from like 40 to 10 or something over a couple of years, but 30-ish and 20, and it started coming down.
Was that after the rate hikes or before it?
That was after the rate hikes, but after the recession that was caused not by the rate hikes, I was there, but I didn't see it coming, but by the fiscal tightening. And the fiscal balance tightened because of the inflation that the rate hikes helped perpetuate. So for example, we had inflation, 12%, and we were running a budget deficit of 6%. Well, in real terms, that means the public debt is dropping by 6%. So that's like running a budget surplus of 6%. And it just got too low to support the credit structure, which was growing because of the inflation. Prices were up. Borrow more for working capital and run your business, and just we call it general money supply. The whole thing collapsed because of overly tight fiscal policy, which looked loose on the surface with a 6% deficit, but beneath the surface it was a 6% surplus because of the 12% increase in prices. And it caused a horrible cave in, and nobody quite understood what it was. They blamed the interest rates on it. The interest rates were actually contributing to the 6% deficit. They were contributing to prices going up, which then caused the real public debt to fall. So in that sense, indirectly, the interest rates caused the public debt to fall because of the inflationary impact. And that's what caused that big crash. And that brought the demand for oil went way down in the recession, and that's what turned it around. At the same time, in 1978, President Carter had deregulated natural gas. And it had all been capped because the price you could charge was only 50 cents when it was worth $2.50 or something. And once he deregulated it, then they could start producing it again, and the utilities felt comfortable switching from oil to natural gas, and that whole transition started and kind of opened the door to that happening. Kept the demand for oil low over the next 10 years or so, relative to what it had been, as utilities converted, and other places converted, businesses converted to natural gas.
I have another question from Buck Franks, who asks, why wasn't inflation coming down on its own during the Volcker era, and they had to enact harsh hikes?
Okay, the inflation came down when the oil price broke. It went from like 40 to 10 or something over a couple of years, but 30-ish and 20, and it started coming down.
Was that after the rate hikes or before it?
That was after the rate hikes, but after the recession that was caused not by the rate hikes, I was there, but I didn't see it coming, but by the fiscal tightening. And the fiscal balance tightened because of the inflation that the rate hikes helped perpetuate. So for example, we had inflation, 12%, and we were running a budget deficit of 6%. Well, in real terms, that means the public debt is dropping by 6%. So that's like running a budget surplus of 6%. And it just got too low to support the credit structure, which was growing because of the inflation. Prices were up. Borrow more for working capital and run your business, and just we call it general money supply. and the whole thing collapsed because of overly tight fiscal policy, which looked loose on the surface with a 6% deficit, but beneath the surface it was a 6% surplus because of the 12% increase in prices. And it caused a horrible cave-in, and nobody quite understood what it was. They blamed the interest rates on it. The interest rates were actually contributing to the 6% deficit. They were contributing to prices going up, which then caused the real public debt to fall. So in that sense, indirectly, the interest rates caused the public debt to fall because of the inflationary impact. And that's what caused that big crash. And that brought the demand for oil went way down in the recession, and that's what turned it around. At the same time, in 1978, President Carter had deregulated natural gas. And it had all been capped because the price you could charge was only 50 cents when it was worth $2.50 or something. And once he deregulated it, then they could start producing it again, and the utilities felt comfortable switching from oil to natural gas, and that whole transition started and kind of opened the door to that happening. Kept the demand for oil low over the next 10 years or so, relative to what it had been, as utilities converted, and other places converted, businesses converted to natural gas from oil. So we had that going on. But if you look at what happened to the price of oil, and it went from like $3 to $40, so 12 times or something, 13 times in 10 years. So that's like today going from 80 to 1,000, right?
Yeah,
and,
yeah. I mean,
okay,
I think
then,
Europeans can totally understand this now a little bit,
and that's
because
what
our
happened, right?
net gas prices did.
But then when it comes down, you'll see the inflation numbers coming down. Back then, they came down very slowly because the high interest rates were keeping them up. Was supporting demand, was supporting forward prices, was supporting the concept. So the inflation came down, but slowly, and they kept the real rate going down. It took 10 years to get down to 3%, even with oil going from 40 to 10. So it's because the inflationary forces from the monetary policy and interest rates were propping things up more than they would have done otherwise. That's the way I saw it.
I think this is very interesting in the sense that I hope also for everybody watching that this gives you a different way to think about this, and this is also something that I don't always agree with it, but I completely see that it's logical. And if I would not agree with it, would only be because I would say, well, I think the borrowing channel is in many cases stronger than the savings channel, or perhaps I would say, well, but I think rates aren't actually that flexible in practice, right? If we talk about the international case, but that's fair, right? That's how economists debate.
I'll agree with you. I'll agree with you. The borrowing thing can be there in the short term. 2 or 3 months, people get scared and don't buy houses. And what the Fed says is that moves things forward, pushes things backwards. And so the interest rate changes can move things back or forward in time, is the way they say. And that's true of a lot of individual items. But so far, we've seen GDP accelerate after the hikes. So we'll see what happens.
Yeah,
we
haven't seen inflation come down.
We've seen the credit aggregates accelerate. We haven't seen the core inflation come down. We've seen headline come down with oil, but not quick.
Interesting.
So we'll see.
Yeah. So one thing, because I also had one question before about sort of trade deficits, and apparently someone told me that you got into a debate with Steve Keen over trade deficits, do they matter or not? And that piqued my interest because I currently would hold the position that I understand why many developing nations want to have a trade surplus. I think it has been demonstrated by Russia, and in the other way around by Sri Lanka and Lebanon, how handy it can be to have a trade surplus, because it gives you a source of foreign currency when other sources get shut down. And the other way around by Sri Lanka and Lebanon, where they had too much of a trade deficit in very crucial sectors that they just couldn't replace immediately. So I would say it matters. I understand why it matters a lot. Would you agree with that?
Well, if you're going to use it to generate money to buy imports, then it's not a trade surplus, it's balanced.
But they didn't do that.
We're talking about using it just to build up
reserves,
financial assets.
Yeah, exactly. As a war chest,
which
is very useful in a financial crisis, or if there's a run on your currency, or if you get in an economic war, as we saw with Russia.
But let's do that one at a time.
Yeah.
So for Russia, it wasn't useful at all because their dollar deposits were all frozen, so they can't even spend money.
Yes, but how are they keeping the ruble up now? Because they still have that currency.
Because they don't
surplus.
import anything. Because they don't import anything. They're not allowed to import. So they have no imports.
Mm-hmm.
So if you're not allowed to import, your currency goes up. Right? That's pretty obvious. So, but
I'm not sure if
the
I would
war
agree that they're
situation.
not allowed. I mean, I know that we wouldn't
Well,
want
that's what
them to
the
import much.
sanctions are. That's what the sanctions are.
Yeah, but they're very leaky, right? They're not really
Sure,
working
but they're not
like
that. Yeah, but they're strong enough to keep the currency.
So you wouldn't see a role for the capital controls that they put in place there, because I would argue that also
Which
plays
ones
a big
are
role.
those? Which ones?
So, yeah, Russia. So restricting
they don't
foreigners
allow-
from fleeing, taking their money out of the country,
Taking rubles out?
or dollars. I don't think it matters.
Well, they can't. The dollars aren't there anyway. They can't. The dollars are credits on Western banks.
Yeah, that's true. Okay, so let's say take rubles out, because then rubles can't be sold on the international market anymore.
Okay, but who was doing that anyway? I mean, they didn't have a problem with rubles leaving the country.
Didn't they?
They had a problem internally with people selling rubles to buy dollars, but not even allowed to buy dollars. The whole thing is they cut out of the dollar market, so they can't sell rubles to buy dollars. Not allowed to. I'm not saying there aren't leakages through crypto or something, but it's not like it was.
Yeah, but that's what I meant,
Yeah,
right?
they
So
were-
you can't
they
sell
were-
your rubles anymore for dollars.
Right, which means they can't import.
Yeah, but it
Yeah.
also means they can't just sell that. You can also sell
Right, I think
for
that-
financial
yeah.
assets, right? You don't have to import a good or service.
Yeah, well, what I'm saying is the trade balance that, shifted dramatically. They stopped importing and continued exporting. And that's where the, and suddenly people who want to buy Russian oil, let's say, they're no longer selling products in Russia and getting rubles that they can use to buy the oil. They have to, get to rubles now because that's what Russia said. But they're only like buying things, only buying things from Russia. So there's no pressure on the ruble. It just takes it all away. If any country stopped importing like that, then your trade goes into surplus, the currency gets stronger. The same way the opposite happened with Europe, where you have to spend more for energy and the currency gets weaker.
Yeah.
Your imports went way up. So your import bill went way up, not the volume, but your import expense went way up. Russia, their import expense went to zero. In Europe, it went way up. Japan went way up.
So I'm not sure
Yeah.
if Russia's import expense went to zero, but
Well, I'm exaggerating a little bit, but it went way down because they can't buy it. They're not allowed to buy anything.
sure,
They're being
yeah.
sanctioned. They're being cut off. They can't get parts for their weapons. They can't get parts for anything. They're not allowed to buy things.
All right. So okay. We may disagree on sort of how much Russia is still actually importing, but to make that into a
Yeah.
fruitful discussion, we have
But
to
it's way
look
down.
into
Let's
the
just say it's
data.
way down.
But,
Let's just say it's way down. Yeah.
But and then finally, and then I think we're gonna round off slowly. How about Sri Lanka and the Netherlands, which were could be coincidental, big current account deficit countries, and they were specifically dependent on crucial imports such as energy and food. Is that a problem? Oh, but yeah, I mean the Russian one, I'll just give
Russian imports dropped from 30.76 to 24 as of January. So they dropped more since. So they're way down.
They're certainly
Sure.
down, yeah, sure.
Way down. Yeah. Okay. So next.
So just Sri Lanka and Lebanon, current account
I
deficit
don't
countries.
know what happened in Lebanon. I know Sri Lanka had a fixed exchange rate that grew up because of borrowing money to support currency, which is it's what I've seen a totally unsustainable process. It runs out when you can't do that anymore. Nobody will lend you the money because it's over. And that's what happens.
All right, fair enough.
Yeah.
Warren,
Yeah.
shall we leave it at that? I think we had I really enjoyed the discussion. I hope it has
Okay,
been a
good.
productive discussion for you as well. I think
Sure.
we went through most of it, right? I think we went through the basics with the how you start with taxing, and then you
Yeah.
can issue money. The taxing gives that money value.
Well, you can spend it. That allows you to spend it.
All right, exactly. Yeah, fair enough.
Right.
And then there's possibly a job guarantee to anchor the value of your currency. But you can do it in another way as well. And then I think
I use the job guarantee as the base case for purposes of analysis.
Mhm.
With the idea that if you want to use something else, fine, then you make the shift. But you have to start with something.
Yeah,
There is
sure.
you can't just have nothing. And so that's my starting point. it's not a policy proposal per se, it's a starting point.
Mm-hmm.
And for lack of anything better, I guess it's a policy. So if you got a better one, fine. So,
Yeah, and
but I
you
think
mentioned you could also use gold, even though you would not necessarily
And people
think it's the
have, yeah.
best, but you could do it.
yeah, but you can't sustain full employment with gold. So you're going to not have you're not optimizing your standard of living or anything else.
And that's actually interesting, I think, like that, full employment is sort of what you have in mind as the best outcome, right?
So, well, I think it's politically has advantages, and what I start with is the idea that you want to have maximum. How do you optimize your prosperity? Your around. The first thing you do is you got to have everybody working to get maximum output. Anybody not working represents lost output. So I did a paper called Exchange Rate Policy and Employment, and it goes into detail on how with a fixed exchange rate policy, you cannot necessarily sustain full employment at all times, but with floating rate exchange rate policy, you can always sustain full employment, which means you'll always be sustaining your real wealth at optimal levels, composition issues aside.
Mm-hmm.
And all the other things that might happen, as long as you're sustaining optimal output, they all become distributional issues, and issues fundamental to your well-being. So you're always optimizing your well-being with floating exchange rate, full employment policy.
Right. Yeah. But there is, I think, sort of, if I can recap our discussion, where we might still have some differences of opinion on which channel of interest rates is stronger, and perhaps on how floating exchange rates really are. And
on the interest rates, I say just look at the data. I understand the argument.
Mm-hmm.
I look at the data and I see that the payment now is dominating, but that could change. And just keep an eye on it.
Yeah, and I think it is definitely something I will dive into, and it's also something that I think sort of mainstream empirical researchers would not look into per se, because that's not what the theory typically talks about, but it would be interesting avenue of research
they talked about it 2 years ago when they were arguing why we can't sustain full employment. Now they're not arguing it, they changed it, they dropped it. They were saying the reason we can't sustain full employment with deficit spending is the deficit will get too large, and then the interest payment, then the Fed won't be able to raise rates to fight inflation because the interest will cause inflation. That was their argument 2 years ago. Now they've dropped.
Right.
Yeah, and the others too. I was just interviewed by Peter, the New York Times, and he went to Michael Woodford, who's Woodford's top guy.
Yeah.
And he said, well, if the interest becomes problematic like that, you can always raise taxes to offset it, which is exactly my point. And they asked Krugman in the New York Times, do you agree with Woodford? He said, yes, I agree with Woodford. Of course, you wouldn't dare not agree with him, because he's a guru. It's not like it's part of the mainstream core model. It's not something I'm just making up that they can refute. It's their own core model.
All right. Well, I think then that's an amazing thing to close off with.
Okay, good.
Warren.
All right.
Thanks so much for this. I really hope that it.
Sick of hiring setters that barely book calls for your business? Use AI instead. We use 5 different AI-driven systems to produce high-quality.
Now that all those programs are behind us in 2020, 2021, where is the extra deficit compared to 2019 go?
Well, it's not as high because it got up to 15% of GDP. Revenues were way down. But in numbers, the spending was high. Spending's higher, but tax revenues are higher also. But it's going to military spending, Social Security, and whoever's receiving the interest. And infrastructure, we had a couple of infrastructure programs kick in. They weren't a lot, but it's adding something. And it's 7%, the government's spending 7% more than it's taking in. And 7% of GDP more, right? So that's an extra, almost $2 trillion. And somebody's getting it, okay? And the data tells you whoever's getting it, somebody's spending some of it. They were saving the whole thing and not spending any of it, you'd be in a depression right now. It's just a question of how much of it gets spent, And so the more you pump out there, whatever percentage gets spent, the more spending there is. Let's say half gets spent. So if you add another 100 billion, you'll get another 50 billion in spending. Let's say 10% gets spent. So if you add 100 billion, you get 10 billion in spending. So you can look at the size of the deficit, you can look at the economy, and you can calculate how much of it's getting spent. And that number is not constant, that will fluctuate. And you also have to look at the deficit spending of the private sector. They're really doing, and that's gone down a little bit because of the banking scare. But you notice we went right through that. Okay, that was a liquidity issue that had nothing to do with bank earnings or anything else. Earnings are strong. Corporate earnings are up. The only reason they were reported down a little bit is because they count the Fed earnings. The Fed's losing, which is deficit spending. But if you take that out, corporate profits are up. Why? Well, the government's spewing out.
About the Fed, I didn't really understand that.
Well, they said corporate profits were down a little bit. Well, they include the Fed's profits as part of corporate profits in those numbers. So
where as part of bank earnings, or what do you mean the Fed?
Well, the total corporate profits for the economy at the Fed St. Louis. If you look up corporate profits, they include the Federal Reserve as a corporation that's earning profits.
Oh, really? I didn't know that.
Yeah, strange. So they do that, and so of course the Fed paying interest on reserves has a big loss. So if you don't count that loss, then the real corporate America outside the government it's hugely profitable. It's at record profit levels because we're spewing out all this money. It's somebody's income. It's going to be corporate income, personal income. And it's profits. It's the old Levy profit equation. The higher the deficit, the higher the profits. It's not like new MMT stuff. This is all mainstream economics. But they're denying their own economics. They're denying it from. They would have been saying this 4 or 5 years ago. Now they're not. They're just eerily silent on this, which was their main thrust. If you look back about all this deficit fear mongering, if the deficit gets too high, all the interest is going to bury us. Well, now we're paying all the interest and we don't even talk about it.
Yeah, well, maybe bury us. They were right about the bury us, just not in a insolvency spiral and more in an inflationary spiral, maybe. But okay,
but they're not there. They're not saying, hey, that's why we're still at 5% because the interest rate's 5%. But it kind of correlates.
Yeah, I just want to go back to the point I made. A little over a year ago, interest rates were at 0, so the interest expense from the federal government was very low. Not counting the Fed.
And dropping.
And dropping. Not counting the Fed, just looking at the Treasury.
Yes.
Roughly the weighted average maturity of the Treasury, I don't know, you're going to know the number, 6 years, 7 years. Wouldn't only 1/6 of the debt have rolled over by now? And isn't that a relatively small increase in interest expense?
Well, but you have to, the Fed bought it. So, yeah, the Fed didn't earn any more interest from the Treasury. But if you look at interest paid to the economy, the Fed had $8 trillion at one point, I think, but $6 trillion now. That's all overnight money getting the full rate. So that's as if the Treasury had that many Treasury bills. It's like as if the Treasury, exchanged their Treasury securities for, 1 month Treasury bills or something. So it just went up immediately on $6 trillion.
Right. So you're thinking of the Treasury and Federal Reserve combined as an entity.
But for purposes of the analysis of trying to determine the income of the economy, you have to look at the income we're getting from all the government agencies, not just the Treasury. We're getting income from all of them. It all spends the same. So, put them all together.
Yeah, and the way that I can wrap my head around that is, the Fed is now paying more than what it is earning on the securities that it bought. So it is basically
massively.
Yeah.
It's $250 billion a year.
So if rates are at 5% are high, that is inflationary, as you say, and the U.S. government continues to run a quite large government deficit, not as large as 2020, but still quite large. Would the solution to that be to curb government expenditure? Because I know, modern monetary theory, reading Stephanie Kelton's book, what one side of the coin is, if inflation is low, the government can do a lot more deficit spending than most things possible. But the corollary, the other side of that coin is, if inflation is high, maybe it's time to cut spending.
Sure. What's the easiest way to cut $1 trillion, $2 trillion in spending? Go back to 0 rates. All right. Are they going to do that? No. They're going to go to 10%, right? They're going to be spending another.
You think they're going to go to 10%?
Well, Volcker had a situation like this where they were kind of like at these kinds of numbers, and then suddenly the employment numbers came out and the inflation numbers were higher than expected. And they just went from, they had like an emergency meeting or something. Over the weekend, they raised rates by what was it, 200? And then they went up from there because as they raised rates, the inflation kept going up, which is exactly what will happen now. If they raise rates, by another 5%, it goes to 10 or something, 10 and a quarter. And now we've added another $1 trillion of deficit spending on interest, so it's over, $2 trillion now. That's just going to make it worse. And so they do it again, and it makes it worse. Now, if the inflation gets high enough where it brings down the public debt even after these payments, we could have a recession, right? So I was in Argentina a year ago, April, and with a meeting, met like this, like you, but it was the head of the central bank, and we had a couple of people. And the first thing he says, we've been reading you for 10 years, so you don't have to introduce yourself, which is kind of nice. And one of his analysts had some paper by, I don't know, Sergeant Wallace or some mainstream paper showing that what I was just telling you about how if the public debt gets too high. And we talked about Argentina. So they had 30% interest rates. The IMF told them they have to keep the rate above the inflation rate. So they had 25% inflation and 30% interest rates. And he said, we really can't do what you're talking about. We have to do this. And it was a nice meeting, but it didn't change anything. So after I left, inflation went to like 35, so rates went to 40, and inflation went to 50, and rates go to 55 or 60. And they just raised rates to 97%. And inflation's up there at 90 or 100% or something. And clearly the interest payments are driving this over there. The people who get these pesos, they don't want to sell them in the foreign exchange markets. Peso goes down, imported prices go up, so inflation goes up, so they raise rates and give them more pesos they don't want. They sell in the foreign exchange market. So they got this vicious cycle going on. And it hasn't ended. Their unemployment's way down. The economy's good. It hasn't caused a recession. So when you got it backwards, where does it end? Does the head of the Federal Reserve say, look, we've had this backwards and now we're going to have to cut rates to control inflation? He can't do that. He's scared to death that if anything like that happened, that the whole monetary system would collapse because they believe it runs on faith. I'll tell you it runs on tax liabilities. They'll tell you it runs on faith. Okay, I'll tell you if it ran on faith, it would have been gone a long time ago. I've seen lots of times where there was like no faith. They keep going because you got to pay taxes. But they don't know that, okay? And they are afraid that this can't get out. I offered to give them a briefing, Jerome Powell, on what I was thinking. And the answer came back is that he can't talk to me because it would be on their logs at the Fed that he talked to me. And they were concerned that if it got out that he talked to me, there'd be some kind of monetary collapse, systemic collapse.
Well, I do.
Maybe he's right. Maybe he's not.
Monetary collapse, but the media would be all over that. As soon as it's
Oh yeah. So he can't even.
Radical economist Warren Mosler.
Exactly. So he can't even talk about it. All right. That's where we're at right now. So how do you forecast what's coming next? It's like you can't. They're second guessing what these people are going to do with their buttons that they have to push. Right?
Yeah.
Look at this insanity of the debt ceiling. That's like every congressman has a button on his desk where if he pushes it, he launches 10 nuclear warheads. And he says, if you don't cut spending, I'm going to push this button. It's like government by extortion, right? The button has nothing to do with the expenses he wants to cut. It's just a way to blow up the economy if I don't get my way. And it's interesting times. I mean, I'm 74. I'm glad I got to see this. But, I guess I could say things were worse in the 60s and in the 70s, but they're not good now.
Hey there, sorry to interrupt. A lot of Forward Guidance listeners are not into crypto. If that's you, please skip ahead, get back to the interview. Some Forward Guidance listeners are into crypto, some own crypto, a smaller percentage owning lots of crypto. I spoke recently with two very smart people who outlined a bunch of mechanical ways the Federal Reserve can help the Treasury if the Congress does not get its act together in order to prevent a default. And I'm not even talking about the coin. I'm afraid we won't have time to talk about the coin on today. But such as
but let's look at but the larger point is, which President Biden made, is that the will of Congress is to do this, destroy the economy or whatever, default. have a dynamic downward spiral. It's not for the Federal Reserve, an agent of Congress, to override the will of Congress. It's not for the executive branch to override the will of Congress. It's to carry out the will of Congress. And that's their macro principle. Now you can say, okay, but the Constitution says you're not allowed to default. The Constitution also set you up as there to carry out the will of Congress, and they've taken the path, the position that that's their role, and so they're not going to do any what I call gimmicks. Okay, I'm not saying gimmicks in a disparaging way, but it's a way to get around the will of Congress. Clearly, the will of Congress right now, until they pass something, is to block all payments and to create a default situation. And these other agencies, branches of government, don't see themselves as their job is not to overcome the will of Congress. And so that we got to get past that first before you can do anything. They have to see it as their responsibility and not the opposite.
Right.
Supreme Court could call it unconstitutional, I guess. Congress can pass something, the Supreme Court can say it's unconstitutional. So they could say the debt ceiling is unconstitutional if they could find a way, and that would change it, and then everything would fall into place. But I don't think anybody else has any authority to override the will of Congress. And there is no case being brought up before the Supreme Court to have the debt ceiling unconstitutional. It may not be. I'm not saying it is. I'm just saying that's the avenue for another branch of government to override the will of Congress.
Well, Warren, you've given me and viewers here a lot to think about. If I had to just look back at our conversation and sort of draw some conclusions, one would be that high interest rates is not necessarily deflationary. In fact, you think it is inflationary because the private sector is net a lender, not a borrower.
It's a receiver of income. It's a net saver. Private sector is a net saver of the entire public debt. The government's deficit is our savings. When they start paying interest on it, they're just paying basic income to people who already have money in proportion to how much they have. A lot of people like basic income, and there's nobody who's supporting doing it that way.
Right. What about if all the extra interest is going to foreigners, China, other holders of U.S. Treasuries, whereas
well, they might not spend it. Some of the stimulus checks went to me, and I didn't spend it.
Right.
So let's say instead of this $1.25 trillion going to interest, it had gone to stimulus checks. Everybody would be screaming, you're running up the deficit, stimulus checks, inflation, you're giving people all this money. Well, you give it to the high end, and they don't even count it. I'm not saying they're going to spend it the same way, but the data tells me they're spending it enough to offset these recession forecasts permanently and turn it on to expansion. And the more you add to it, the more of an impact it has. It becomes a larger and larger percent of GDP. It's almost 1 for 1. If interest expense goes up to, if rates go to 10%, interest expense ultimately goes to 10% of GDP. If the public debt's 100% of GDP, it's actually higher than that. So it goes up roughly proportional to GDP. So 1% interest, when they raised rates 0.25%, deficit spending went up 0.25% of GDP, roughly. Now I know it might only be 0.2 years, roughly. And so that's what they're doing. And of course, the more you do it, the higher the public debt becomes as a percentage of GDP, so it gets worse and worse. And the mainstream economists up until COVID were screaming about this. That's the risk of the deficit, and now they're quiet, not a word.
So it was mainstream belief up until COVID that high interest rates caused inflation.
If the debt to GDP is high enough to offset the difference in propensities between savers and borrowers. If it's high enough to offset that, then it flips over, and the Fed can't use that as a tool anymore. They didn't specify whether that's at 70%, 100%, 120. They just said if it gets high enough. Now they're not even talking about it. Okay, not mentioning it at all. They're saying, oh yeah, the rate hikes are going to be deflationary because the borrowers get hurt. They're not. They've just left that out of their equations, and it's in their textbooks. It's in their model. It's in the New Keynesian model. It's got the interest income right there. The deficit is a calculation in the New Keynesian model. They see it as 4% of GDP from interest, but they're not directing any attention at it. There's nothing MMT about this. This is just arithmetic.
Does that relate to the crowding out, a theory that MMT challenges? That if the
No,
government
see, what
borrows
they-
so much money and
Right.
has such a large deficit, then there's no
Yeah.
more money for the private sector, right?
Right, that got dismissed with the idea that you spend first, and then you're borrowing some of the money you just spent. So you're not crowding out, you're adding the money first, some gets used to pay taxes, the rest has nowhere to go. Money in Fed accounts can't go anywhere except to another Fed account. You give them another account called Treasury securities to earn interest. You haven't crowded out or affected anything in nominal terms. Now, if the government buys, all the bananas, it's crowded people out, nobody can have any bananas, that's different. But for money in nominal terms, there is no such thing because of the sequence, spend first and then borrow. So clearly it's not applicable to that. The idea of crowding out in terms of monetary terms is just not applicable. And this is to a floating exchange rate system. Okay, the things you're talking about crowding out, they are applicable under a fixed exchange rate system where the Fed has to have the money back on gold or something like that, and it can run out. There's not enough gold to go around. They compete with rates, the market can drive up rates. All these other things were, anachronisms from the gold standard.
Right. One other thing is when the currency raises interest rates, central bank, Fed raises rates, that tends to, not always, maybe all things being equal, strengthen that currency, as we saw the dollar strengthen a big time in last year, and therefore, if you're selling goods to Europe and China, it's really bad for producers, right? So that's But
but look at Argentina. It only happens for short periods of time. It's more of a placebo effect. You've got everybody raising rates at the same time, and you have different inflation rates, and you have different effects on trade from the price of oil. That was the biggest mover of the currency. The dollar got hurt less in terms of trade balance from the big run-up in oil than like Japan. So the yen went down because they're a major importer of energy. Right. They had to spend all this yen, flood the world with, so
that was part of it, but also part of it was that yen rates were at zero, right?
Well, they've had the lowest inflation with the zero rates, and we've had higher inflation, much higher with the higher rates, and so has everybody else. Not that that's everything, but it's look, all the central banks have done a lot of studies on whether interest rates can be used to support or not support their currency, and I used to read those reports all the time. The famous one was the Bank of England showing no correlation that interest rates are not, the currency level of the currency is not a function of rates in the direction they want it to do. That was about 15 to 20 years ago. I haven't read one since because there hasn't been one, because they can't find that kind of correlation, so they don't even publish it. Remember, the central banks used to publish all these studies that showed, a 1% increase in rates would cause inflation to go down by 1/10 with a 2 to 4 year lag.
I don't remember that actually, before my time.
Yeah, that was like 20 years. They haven't come out with those. Have you seen any study by any central bank showing that if they raise rates, it'll bring down inflation? No, because the staff can't find it in the data. Because the interest expense dominates, is what I'm saying. And it dominated when debt to GDP was half of what it is today. Now it's double or 3 times. If you look at held by the economy rather than held by the government, it's 3 times. It's got triple the impact. I can't see any way it's not dominant. But, I could be wrong. I'm just sitting here in St. Croix in a pair of shorts talking to you.
Yeah. Well, final thing I'll say is that the Federal Reserve losing tons of money, that being stimulated for the American economy, that makes sense to me now because the Treasury bought tons of low yielding paper. But in 1996, when the Fed's balance sheet was not that large and they didn't buy tons of mortgage-backed securities when people were taking a mortgage at 3% and then they wouldn't refinance. That's interesting. And also I'll say on the currency thing that when Argentina raises rates to 20%, it's not enough. They raise it to 30%. I can see that spiral, but would you agree that the U.S. dollar is the at the top of the pyramid? It's a currency hegemon. There will always be a bid for the dollar while we're in the dollar system, and people betting against the dollar system, it has not been a great track record for 70 years.
Yeah, I say absolutely not. It's there for other reasons. It's a numeraire internationally, and what we have, fortunately, are countries that are have an export-led growth narrative. Okay, so you have Japan, Korea, China, and they buy U.S. dollars because that causes them to be net exporters to the United States. to support their exporters at the expense of their macroeconomy. And it keeps the dollar firmer than it would be otherwise. They don't care. They're doing it for other reasons. All right. And so I have a whole different narrative for what's going on there, and it's got nothing to do with the headline narrative in the media. And that would be a good one for another show.
Yeah, good one for another show. Well, Warren, you've given me a lot to think
Okay.
about. My favorite types of interviews are ones where my mind is blown a little bit. I'm a little bit confused.
Okay.
I feel like if you're not confused,
Okay.
you're a lot learning. So thank you
Yeah.
so much for coming on Forward Guidance. So I just want to say, people should check out your book, 7 Deadly Innocent Frauds of Economic Policy. So when the Federal Reserve expands its balance sheet via quantitative easing, QE, or reduces it via QT, quantitative tightening, that does not change the government's deficit or surplus, correct? And
That's
the
right.
deficit, that is the government spending money such as it did in 2020, and that can be efficient. Yes?
Well, it doesn't. So it doesn't change the public debt. It just shifts those dollars that they've spent but haven't yet been used to pay taxes between savings accounts and checking accounts at the Fed. That's all that QE and QT does. It's to shift them back and forth. Okay. So what does make a difference is spending. Okay, when you buy something, that makes a difference. Or taxing, when you debit people's accounts, that makes a difference. But not shifting dollars between checking and savings accounts at the Fed, not QE and QT. It was an enormous experiment, and it showed to all the statisticians it doesn't do anything. It has a placebo effect. People who think it'll do something might change their behavior, so it has a placebo effect, no question about it. But it doesn't have an actual effect on the monetary, on the economy. Now, if they increase interest rates, on the other hand, which is what I've been on for the last year since they started, you don't even call that MMT. This is just monetary operations. What does happen? Well, the deficit spending goes up to pay the interest because the government's got $31 trillion of outstanding dollars in checking accounts or savings accounts. They both pay interest now. The Fed pays interest on all the checking accounts. The Treasury securities pay interest. Those interest payments go up.
Only on bills that have to be rolled over, right? If you issue a 20-year note at 1% and then interest rates go to 5%, you're still paying that 1%. The Treasury's still paying the 1%, so it's gradual, right?
Right, but a lot of those are $6 trillion of them are owned by the Fed. They bought them, and the Fed pays interest on the deposits it created when it bought them, and so it shifted people's money from Treasury securities to, savings accounts to checking accounts, to Fed Reserve accounts. And they pay for the full rate on that, full 5.25 instantly goes up straight. So that shortened the duration, is the way market participants would say, of the portfolio. Now the other thing is reinvestment rates matter. If you've got a bond coming in a month, or a Treasury bill that's going to mature in a month, and your reinvestment rate went from 0 to 5%, that affects your planning, your behavior, especially if you're an institution. It affects it dramatically. So the effect of rates acts on these securities that haven't matured yet. They're in all the calculations that all these institutions make for their asset and liability management. And so they have an immediate effect. Now it's not identical to the zero duration, it's just overnight accounts where the interest goes up immediately because it is delayed, but it still has a substantial effect on the markets.
The way that I can kind of wrap my head around it, Warren, is that if you're a company and you issue a bond at a very low rate and then rates explode higher, you had a good deal. In the same way that if you got a mortgage, you bought a house with borrowed money, you borrowed it at 3%, and now mortgage rates are at 7%, you feel, winner, winner, chicken dinner. Likewise, the U.S. government Treasury issued a ton of debt when the 10-year was 1.1%, 1.3%. And now that the 10-year is close to 4%, it's like the U.S. government made a lot of money that way.
Yes and no. If you have a mortgage, 3%, you didn't get any money. Your income didn't go up. Okay, you're glad that your income's not lower than it was, but it didn't go up when they raised rates. It just stayed the same.
Right, but the opportunity, if you were to borrow now, you borrow at 7%. So
That's right. Right, so that might slow down somebody's decision to borrow. But if his income went up more than that, then he might say, all right, I'm going to buy this house. So if you looked at the number of housing starts in the late 1970s, when people in my generation were paying 15 and 18% for mortgages, we had more housing starts then than we do now when mortgages are 7%, because the incomes were going up fast enough to cover it. And you know, you can go through the statistics. Most of U.S. history had mortgage rates higher than this, and most of U.S. history had housing starts that were much higher than this. Okay, and our lowest housing starts came when we had the lowest rates, because it's a policy move, right? So anyway, but the thing is, at the macro level, if you look at the economy as a whole, there's always winners and losers. You picked out a person who won, and there are people who lost who had to get a mortgage the next day, and their income did go up, and they were, you know, they just lost their job. Even though there's unemployment's at a record low, there's 3 or 4 million people losing jobs every month, and 5 million people getting new jobs. So there's, you know, millions of winners and losers. So that's fine. You know, I certainly respect that. But let's look at the total first to see what's going on at the macro, what we call the macro level. At the macro level, government interest expense is going straight up, the amount they're actually paying, and particularly when you include the interest, the net interest the Fed is paying. It gets interest from the treasuries, but then it's paying out a lot more on these deposits, because like you said, the treasury rates are fixed. So the Fed's been, from an accounting point of view, the loser. It's not losing them from anything else.
The former, the interest expense of the treasury going up, if I were to look up, you know, the St. Louis Fed, Fred.com, that would certainly appear the interest expense is going up. But the second part, the fact that the Federal Reserve is now losing money because they basically are a bank and they're paying 5% in reserves, and they bought mortgage-backed securities that yield 2%, that would probably not appear on Fred website, because officially
it does, but it shows up as a drop in the Fed's capital account.
Right,
So
which now is in negative. So it has a,
Right.
what's the, forget the exact phrase, a deferred asset.
Right. So when the Fed spends more than it takes in, the accountants have to, you know, debit some account, and they debit their capital account. It's a way to keep track of it. It doesn't affect operations or anything else. It's just a way. Accounting is just keeping track of what already happened. So the Fed credited an account, they keep track of it by debiting another account. It's called the capital account. You can see that going down. And that tells you how much they credited the other accounts. And, you know, 6 trillion at 5%, it's 300 billion years. And annual rate. It's up there, you know, over 1% of GDP. So it's substantial. Now, if you look at government interest payments, without just those two together, we're annualizing at somewhere around 1.2 or 3 trillion dollars, which is substantially larger than the military budget. And if you look at the deficit spending for the country, it's 7% of GDP now, or something like that. Maybe 4% is interest expense. It's a pretty high number. And so we are raising rates has increased the federal deficit, which is a stimulant effect. It's a adds to income and it adds to savings, and it's like kind of like a stock split or something like that. The stock traders out there, right, or a stock dividend. They're just giving out more of the same thing. And you know, when they give out a stimulus check, it sort of goes to lower income people, right? At least in theory.
People with a higher propensity to spend.
Yeah, but when they pay out interest, it's going only to people who already have money in proportion to how much they already have. So it's kind of like a stimulus check for people who already have money in proportion to how much they have. And it's, you know, multiples, many times larger than the stimulus checks they handed out on the other side. So if you just look at it, I've never seen this debated from a social equity point of view. Oh, we gave out 500 billion in stimulus checks, but we're giving out $1.25 trillion in interest payments, which is kind of the same thing, basic income, but for people who already have money. And it was done by a few people at the Fed. It wasn't like debated in Congress, do we want to do this? And they're doing it to fight inflation. So they're fighting inflation by flooding the economy with dollars, with money. You know, it's a massive flooding the economy with money. It's a massive increase in the deficit. And so a year ago, I'm saying, like, this is not going to cause a recession. This is going to cause a strong economy. Now, I agree with you that this money that these dollars are paying out don't have as high a multiple maybe as the stimulus checks. You never know that until after the fact when you look at what people did. It turned out a lot of that money was saved and not spent, right? Personal savings went way up. If you look at what happened, instead of going into recession, we've been growing at, I don't know, 2 and 3% real growth, which is pretty good. So it means a pretty good portion of this interest money is somehow getting spent in supporting the economy. and it's supporting prices. It's not a deflationary factor, it's an inflationary factor. But there are other deflationary factors like supply chains sorting themselves out and the oil spike from the war reversing and bringing prices down and whatnot. So, there's all kinds of factors going on. So I'm just talking about one factor. This is not like the end all for this CPI next month or anything. But what we've got underneath is and the other thing that's happened is the debt to GDP, the amount of debt we have based on the size of our economy, is triple what it was before COVID. So before COVID, we were like 30-35% of debt to GDP. So if GDP was 20 trillion back then, we had maybe 6 trillion of debt. Today, we've got over 100% debt to GDP. So with GDP of 25 or 6 trillion, we have 30 trillion of public debt, which is over 100%. And the public debt held by the economy, not by intergovernmental agencies, is 25 trillion. That's about 100%. So the amount of debt held by people in the economy, not intergovernmental, has effectively tripled. So an interest rate increase has 3 times the fiscal impact now than it did in the last.
Right,
So
so
this-
Warren,
yeah, yeah.
I just looked it up
Yeah.
from the Fed.
Yeah.
News that federal debt, total public debt as a percentage of gross domestic product,
Yeah.
that change said it was already pretty close to 100% in 2015. So you're saying you're canceling out the fact that a lot of government agencies.
Look at it in 2007 before the last crisis, before the last
it was
cycle.
at 60%, and then it went to
Right.
like 100%. Yeah.
Yeah, right. Now look at the percentage held by the public. That'll be there. And it was like in the 30s back then, and now that's up around 100.
Is that because the Fed bought so many of the Treasury securities?
Yeah, well, I don't go to a Social Security account and stuff like that. Back then.
Okay.
And after COVID, it went, all the new deficit spending disproportionately went to the economy rather than to like Social Security trust accounts, which is kind of a fixed number.
Got it. So I just want to say,
Yeah.
most of what we've discussed,
Yeah.
Warren, so far for the audience, is part of mainstream modern monetary theory, that framework, which you helped create. But
Yeah.
this, I heard you say earlier, your theory that higher interest rates are inflationary and lower interest rates are deflationary. Not only does that challenge mainstream economic thinking, but this is not a mainstream view of MMT, right?
Well, 4 or 5 years ago now, when I talked to mainstream economists, like I had a conversation with Paul Krugman, and he was in a debate with Stephanie Kelton on Bloomberg over deficit spending to sustain full employment. His argument to me was, look, I said, well, why can't we just sustain full employment? He said, well, if the deficit gets too high as a percent of GDP, then the Fed can't raise rates to fight inflation because the interest payments at that point would be inflationary because they'd be so high. So the Fed would lose its tool to fight inflation if we let the deficit get too high. So I'm thinking,
Because
well,
high interest rates are inflationary?
yeah, because when they raise rates, it increases deficit spending, it causes inflation. And so you got countries like Argentina with very high rates, and their deficit spending can be 20 or 30% of GDP. Okay, not 4% because the rates are so high. Well, that causes inflation. You can't just spew out that much money and not expect to have inflation. Right? And so, they've got 100% interest rates now. The debt to GDP is low; it's only 30%. But that means the interest is 30% of GDP. Right? Big numbers. Okay, and so, so what Paul said was absolutely correct, and this was straight mainstream argument about why we should not allow the debt to GDP to get high. This was other arguments. You can't let the debt to GDP get too high because if it does, you better not raise interest rates, okay, or you're going to create inflation. So Japan, the debt to GDP is like 200%, maybe 160 held by the public. If they were to raise rates, that would be, the interest payments they would be making would be inflationary. They'd be paying out all this interest to people, huge amounts because the debt's so high. You pay interest based on the debt. And so that was the mainstream argument against deficit spending to sustain full employment. Of course, my answer was, if you have a permanent zero rate policy, it doesn't matter. You're never going to raise rates. You're going to leave it at zero or it will go up. That's a different argument. I'm not going to make that clear. But what I'm saying is the mainstream argument was, don't let the deficit get to where it is today, or you take away your ability to raise rates, it's going to cause inflation. And here we are, and they're silent on it. They're quiet. They're not talking about it. Peter Coy did an article when I explained it in the New York Times about a year ago, and now he's seen it all happen, so I think he's going to come back and follow. He talked to Michael Woodford, who's the #1 monetarist. He's excellent, mainstream economist, the Fed's economist, and he doesn't have this bias. And he said, well, you don't know because we don't know about the multiples, but if it does, then we'd have to raise taxes or cut spending to offset the increase in interest payments. Okay, and that's exactly right. That's exactly what I've been saying. Now he's going to go back to him again to see if he believes we're at that point where it's been supporting the economy. To me, you don't know until you look at the data. So when I was saying it a year ago, there's pure speculation about what's going to happen. Maybe the propensity to spend interest really is zero. And look, none of the MMT academics jumped on this bandwagon because maybe the propensity to spend is zero and we're going to go into recession. But it didn't happen. Instead, the economy's been growing, which tells us the propensity to spend has been above zero. And that as we raise rates further, it's only going to support growth, and employment. We're at a 50-year low for unemployment after raising rates for a year, a record number of basis points, whatever. And we're going to overheat if we keep raising rates like this. That's what the data's telling me. Okay, I'm one person. It might be telling you something else, but that's what it's telling me. That these rates are a direct increase in deficit spending, 1-for-1, because they're 100% of GDP, so you raise rates 1%. Over time, you're raising the deficit by 1% of GDP for every 1% rates. Yes, there's a delay and there's reinvestment. I understand duration. But that's roughly what you're doing. And you keep doing this, you will we raise rates from 5% to 15%. We're going to see the deficit go up to from 7 to 6 or 8, to, I don't know, another 6%. We'll be up to 12 or 13% of GDP, which I think is going to be highly inflationary if we raise rates that high, if we go full Volcker. Now, what did Paul Volcker do, who happens to be Jerome Powell's hero?
But yeah, that's my next question. So Volcker, you're familiar with the narrative.
Yeah.
Jacked interest rates to 18%, inflation dropped like rock. Then rates go down shortly. Then he raised them back up, and how do you doubt that narrative? Because you're absolutely right. Zimbabwe, interest rates way above 100%, and inflation is close to 1,000% in Argentina. But in developed market countries, typically higher interest rates are associated with causing recessions, causing deflation, causing a credit crunch.
Right. Also, budget surpluses are causing credit crunch. You have to look at the budget deficit or surplus in real terms, because people's savings are in real terms. I used to walk around with $20 in my pocket. I thought I had a lot of money when I was a kid. I didn't have dollars. And now it's $200. If you go shopping and you need $200 and prices double, you need $400. If your Apple computer with 200 billion, the price is double, you need 400 billion. So the savings needs, the cash needs, the net financial assets of pension funds, when prices double, it all doubles. So they look at it in real terms. How many dollars do we have based on prices? We've got to give an employee enough money to live off of when he retires. Okay, so what happens is you have to look at the public debt, and then you look at how it changes from year to year. It goes up by the budget deficit, but it goes down because of inflation. People call it the inflation tax, right? And so when Volcker was around back then, the public debt, the annual deficit was about 6 or 7% of GDP in the late 70s, but inflation was 12 or more. And so we had the real public debt going down by 6%. Right? So we had a massive fiscal contraction going on. It was the first decline in the real public debt in a long time. And economists pointed it out at the time. And that is what caused the economy to crash, okay, along with what OPEC was doing with the price of oil, which caused a glut in Jimmy Carter's deregulation of gas. A lot of people switch out of oil to gas, but that took a while. That didn't happen in one day. But there were all kinds of factors substituting out of $40 oil. Oil had gone from 3 to 40. Okay, it was up like 11 times, which is going from 70 to 800, right?
Yeah.
It was a massive inflationary thing going through the economy. And that caused the real public debt to collapse. And we had one of the worst recessions we had, and they credited the interest rates. Now, I credited the fiscal collapse because when I look back at every recession, every economic cycle, there's always been that kind of fiscal contraction associated with it, every single time. And the interest rates were adding income, they were adding to the deficit, but not enough. Okay, with the inflation, you had what we used to call bracket creep, I don't know if you call it today. But when your income doubles, your tax payments double, and you go into a higher tax bracket. So we had this ripping inflation, so tax receipts were going up even faster than the government could spend money, even faster than the interest rates were causing the government to spend money. And the budget went into a real surplus where the inflation was higher than the deficit. And we had that collapse. It's a little bit technical, but it's, I don't think there's any dispute when we look at it, but that's what's happened. Now somebody else could say, oh, I still think it was an interest rates. Counterfactual is counterfactual, but it's, my narrative is entirely consistent with what happened then. And it was what I was saying back then, in real time when it was happening. I was on the trading desk. I saw Fed funds 28 bid, no offered on the Wednesday. The absurd monetary policy we had to cap, borrowed reserves. It's like, what's that about? It's just like, I don't know how to go into it, but it was embarrassment as an American to see a Federal Reserve chairman doing that, and then they build a statue to him for having saved the world. But that's the way it is.
If Volcker had kept interest rates where Arthur Burns, I don't know, 8%, are you speculating that inflation would have gone down faster?
That's a good question, because that last move in oil went from like 30 to 40 or something, 25% move, and it would have been hard to stop CPI from adjusting, and it wouldn't have even been good policy to do that. When you have a foreign monopolist setting price like that, either your real terms of trade go down, or you just, got to export that much more to get the same amount of oil, or you adjust your prices, and you've got what I call dueling monopolies, right? And but I can say that the high rates contributed to the income that was able to pay the higher prices, and they supported the inflation that then brought down the real public debt, because the inflation tax on everybody's savings caused everybody to be relatively broke, because you had the same money, but it didn't buy anything. So now there's a money shortage. It causes a money shortage. Inflation causes a money shortage. Money defined as net financial assets is defined as savings in the economy. Inflation causes a shortage of savings. It destroys them. And then you've got that's a deflationary or a contractionary, not so much deflationary, but a contractionary event that causes a recession.
Right, so inflation eats away at savings, and it eats away at the government surplus in real terms. So as you say, inflation itself, contractionary, disinflationary, like the inflation reaps disinflation. That there's a narrative that challenges that inflation itself is inflationary, because you build this inflationary psychology. The wage price spiral, people's price of cereal is going up 15% year over year, so people need a 20% raise year over year, and then the cereal company paying 25%, they have to raise prices by 25%. What do you think about that?
Yeah, if you get wages leading prices because of, I don't know, you have countries like Turkey where, for political purposes, they'll get a lot of inflation, but they want to make sure their constituency is okay so they can keep winning elections. So they'll give workers, 50% increases so they keep up in real terms and don't get hurt. And that's their political constituency. It works from the bottom up. It's actually progressive in that sense, financially. I'm not saying that society is progressive, but it's a financially progressive way to do it. And then the rest of the people who aren't the lowest wage earners have to scramble to somehow save theirs, but the government advantages the lower end. And that kind of indexation can create more inflation. They just keep giving those people enough to stay ahead, and politically it keeps them winning elections. And so it's sort of a progressive way to do it, although I'm not, again, making any claim that it's a progressive society overall, but it's just that narrow, particular financial aspect is progressive. And that's been done by, South America and other places where the political leadership looks to index wages, government wages, to keep up. So their constituency keeps their real incomes up. And they just keep doing it, redenominate the money, whatever. And they stay in power for long periods of time.
Right.
But it's a reality. It's a political reality. I'm not proposing. It's not my proposal. Okay.
But a motivating force for central bankers, at least in the developed world to keep inflation low at 2% is if people get used to 6% inflation, they're going to demand a wage increase of 10%, 8%, and so it will feed it on itself. So you have to sort of crush this inflationary psychology. I'm pretty sure Jay Powell believes that.
Yeah, I think he does, but I don't think that the way the institutional structure is that wage earners are in a position to demand anything. At the end of the day, they need to work or they're not going to eat, and they can't just walk off their job. They can't do that. And so it's this huge disparity of power, and business only hires if it likes the return on equity. If they're going to pay too much, they just won't hire anybody. They're not forced to do that. People, even if you're the last guy being hired, you're the last guy unemployed, you get offered a job. If you don't take it, you can't eat. And so you don't have a whole lot of power there. So I think that it's simple game theory, that people have to work to eat. Business only hires because it likes the numbers. There's a huge disparity of power here, which will keep wages at some kind of minimum, which has happened since 1980.
I think that perfectly describes American labor life, 1980 to February 2020. Are we not in a new era now where the Atlanta wage tracker is going up? I don't have the exact number in front of me, but for the lowest quartile wage earners, it's going up a ton. Service workers, they are seeing wage gains that they have not seen perhaps for their entire lives. But I'm not saying that's a bad thing by any means.
No, but it hasn't kept up with inflation, and it hasn't gotten them ahead yet. But and also, look, if somebody's was making $10 an hour and they go to 15, that's a 50% increase. They're still only making $15 an hour. They still have to live home. They still have nothing, right? And so when the bottom half gets a large percentage, it's not a lot of money. So it's you go just saying.
Right. Yeah. So I'm seeing, overall it's up 6%. Yeah. So it's pretty. Real personal income. You're right. Is actually slightly negative. And yet, so how is it that we have this boom?
Well, it's growing, okay, and we don't have like a 5 or 6% GDP. We've got 1 or 2, and you've got during COVID, people's what we call savings was actually they didn't borrow credit cards and whatnot. They went down, so debt service is extremely low. People are in a position to leverage, and a lot of this boom is by higher income people whose income has kept way up because they're getting $1.25 trillion interest income. So Rolls Royce sales are sold out for the next 4 years at $425,000 a car. and now we're seeing people at the lower end are getting squeezed. They're not keeping up with inflation. So we've had a big shift, in terms of distribution of consumption underway. With these interest rate increases. With the zero rate policy, we actually saw a distribution of consumption starting to, it stopped going the wrong way. Maybe went the right way a little bit. I haven't seen any real good numbers on it. But now that the interest rates are back up and the higher income groups are just getting free money, you're seeing it start to go the other way.
Right. But you said that, people didn't borrow money in 2020 and 2021. I think that is because they had excess savings. Like if Bank of America put out, if someone had $500 in their bank account in 2019, they now have $3,000. I mean, I think people's savings account went up by a lot. And when I say boom, I was referring to 2021. That time, I personally am not a belief that we are in a boom now. But it is definitely true that the recession fears of last year the economy is not as bad as we thought.
The deficit got up to 15% of GDP during COVID. Okay, and then it collapsed to like 4, and that's when everything went down. And we had 2 negative quarters last year. And I know its inventories are going up, but I think it's also for that. It's not getting too deep, but it was still down. And I thought it was going to keep going down. And then they started raising rates and started pushing the deficit back up. It's like, okay, now we've got a new fiscal cycle, proactively going the other way. And so the rate hikes kind of saved us from the recession that was happening because of the collapse in deficit spending. And if you look at what inflation was doing, the collapse in this real savings. But then it turned around and went back up from the interest expense, government interest expense, with deficit spending, plus increases on Social Security, 8.9% or something, plus all the military spending. Okay, so we had all kinds of fiscal spending kick in to reverse that decline in proactively go up. It's not
Because a
going
lot
up
of those things
every-
were pegged to inflation, right?
Yeah, they are, yeah. And military spending's all pegged to inflation. You know, they're gonna buy a certain number of bombs, whatever, no matter what they cost.
And so, Warren, given that your framework, MMT, places the government at the center of all sort of monetary operations, I want to ask you about the reason.
Yeah, it's a public, the currency itself is a public monopoly, so it has to be at the center. It's based on coercive taxation, which is government, and the private sector has to comply.
Yeah, I knew you were saying it that I was not going far enough. It's not only the center; it is the entire map. What about banks, which yes, they are regularly chartered, but when a bank, let's say JP Morgan, wants to make a car loan, when interest rates are a lot higher, people are not going to want to borrow as much, and people who are borrowing money to finance their lives and their livelihood, they're going to pay a lot more. As well as, by the way, very wealthy people are not they're not exclusively savers. A lot of very wealthy people are very much in debt. They borrow a vast amount of money to finance their equity, real estate, and stuff like that.
So if there's winners and losers, but overall, the total deficit's looking at 1.8 trillion for the year. Somebody's getting that money, okay? And the winners are getting 1.8 trillion more than the losers are. It's a lot. And so car sales have gone up, even though rates have gone up. Housing, we're not calling this, but it looks like housing may have bottomed in November, December. Sales starting to pick up a little bit. That's the one area that we thought would have collapsed. Housing prices are like flat year over year. I think they were up 0.7 on one index, down 0.4 on another. But basically,